You keep asking people whether to buy or sell, especially when we have major news line up on the economic calendar. Today I want to teach you how to analyze these data so well, and at the end of this video you realize these data are really connected to each other and they are not really random. At the end of the video, actually, you'll remember my name and then take forever just because of this. Ensure that you subscribe, like, and share, and let us know in the comment section what we'll be learning this. We'll be starting right after the intro of this video. Now, this is the Forex factory calendar. You can actually get the economic news of different currencies. But number one, we want us to start today by US dollar. So we are going to go to the filter, and then we're just going to filter all these ones, and then we just remain with USD. So we remain with only USD, all right? Then you click apply. So I want us to be remained with only these. Now, this data is actually not random, as I said. Now, where do we start? If you're a total beginner, you can actually go to the forexfactory.com. You can get these news in different websites, investing.com. Actually, these news are available in different platforms, but you're actually going to get them just the same. Okay? Whether it's just, you're going to get them the same. The releases are actually different because here we normally, if you're going to be dealing with the US, the reason we're going to be dealing with US is because it is a major where we actually have a big economy happening in the US. Trust me, I'm going to be working with you slow by slow on this. Now, economic news. We have different types of news that we can actually get from the market. We have these economic news that we can really get. These are like the data that we get on how the economy is performing. We can actually get this fundamentals news. These are very important. Why? These are the kind of news that you're really getting. These are bombing that takes place. You're not going to see it on the Forex factory calendar. These are the news that you're going to see on Bloomberg TV. You know, there's an attack that is really happening. And most of these actually will drive what we call the sentiment. All of them, sentiment news. All of these drives to sentiments. These leans to the sentiment. What do you mean by sentiment is how people feel. And this is actually what moves the market, the sentiment news, because all these news leads to sentiment. That is what I'm saying. Economic and fundamental news, they're all linked to these things. It's actually very interesting. It's an extensive area. I don't want really to cover much on this. So on the economic news here is we're really trying to understand what the economy is actually doing. And that's why we are going to be dealing with the United States, okay? The reason we're dealing with the United States is because there are some things that happens in the United States that you're not going to see in Japan, or you're not going to see sometimes being used in Kenya. For example, when we have people really working in Kenya, we normally say about salary, right? But you know, in the US, this is Kenya, people get salary after working from either 8 to 5 p.m., 8 a.m. to 5 p.m. But when it comes to US, actually, we talk about the average hours, like the hours that you're really working. That you see people saying, I work 40 hours per day, I work 20 hours per day. So that is the difference. That is the difference. That's why I'm saying that we are going really to start with the United States. There are some nations that you really have to understand. Number one is the economy of the US, and number two is Japan. And that number two, Germany, Canada. These are big things when it comes to the Forex market. But the biggest of all is the US. Hey, that is where we're going to be studying more about the movement of the US dollar. And that is where we are going to start. And that's why we are going to have different terms here. We'll be moving. If you like this, you tell me whether you can continue with the rest. Now, when you talk about the economy, what is the economy doing? What is the economy doing, right? When we talk about the economy, all these things we are really going to refer them back to the Forex factory calendar, and you're going to see how they are really connected to each other. Now, where do you start? Before even we move to the calendar, because if you move to the calendar, I'm going to see different result. For example, I'm shooting this when we actually yesterday was CPI and today was actually the PPI and the last week was NFP. All these data are really correlated to each other. This is how they connect to each other. And where do you start? Because let's say, before you see this phone that I have here, before you see this phone, the price of this phone, if I have an iPhone 13, before that iPhone 13 is actually priced, there is the source, is where where it is actually started. All these things that you see, like for example, you buy a brand at 50, it's not just a random price, it's price that has actually been determined by a lot of things. Now, to know how the economy, if you see the economy is actually collapsing, it does not even start from just collapsing. You actually it is start actually from the production level. It's just the same the way that people feel. When you see a person just collapsing, like, we are working with a person, then he just collapses and dies. Yeah, that means that person has been healing for long. And when you go and test that person, probably he had some diseases that was really not tested, or maybe there's something that has been disturbing that person inside. All right. That is what you really have to understand about the economy. You have to understand about this microeconomics. Have you seen people actually stand microeconomics? This is actually even a topic I think in campus. There are so many people who study these topics about microeconomics. That these are the micro things that normally affect the economy. And this is where I normally start. Before anything, that is where you see like a small virus here, it brings to big virus or maybe affect a person, and then it kills a lot of people. Now you really have to understand about the micro, right? The micro, the beginning of the source, what is really going to be causing this. And that is the same thing that really happens to the market. All this data that you see on the economic calendar, they are not really random, is where they really start. Let's start with this. For example, there's a data known as number one, purchasing manager index. What is purchasing manager index? This is known as PMI. This is type of data that we really get from the market. This is the data that we really get from the economic calendar. Normally, look at this, purchasing managers. These managers actually they monitor something like the production cost. What is the cost of production? In this case, I want us to take let's take a sample of a phone. Right? I want us to get a phone. The production cost. What is the what does it what did it really cost for us to be able to get these materials to get the phone? Probably the chips, there is plastics that can really be in place of the phone, all those raw materials. What is the production cost? What is the product cost of these materials? We have purchasing of raw materials. This is all the way from the production, and this is known as the PMI, right? This is by ordering this one supplies. Let's say, for example, these materials have to be transported. In case maybe there's a problem on the transport or the transportation of these raw materials is becoming really complicated or expensive, of course, this has really to be counting from that. That is where the problem start. Like supplies, you can actually talk about the supplies. I want us to understand more about the PMI before even we move to anything else, so that you may be able to understand this cycle. All right. Now, before even we move to that, this is how now it is drawn. We have what we call the cost. The cost is what brings the price. You cannot say that this phone, I'm going to sell it at 20,000. What is the cost of production first before even we price this one? And then also, it will depend. Demand is going to be very important here, because if the demand is going to be very high, it's going to affect the price. All right. And when the demand becomes so high, people buy so much. Actually, this, of course, will attract whether this is going to be a growth or the things is really going to die. It's the same thing that you have seen the currency dying, and then what normally happens when the currency is dying, or maybe there is something happening to the currency? Of course, a monetary policy, central bank has to intervene. That is the cycle. This is the cycle that we normally see when it comes to now to this market. And that's why we are starting with the production part of where we talk about the PMI data. So this is where on the production part, this is where things start. This is why everything now starts on the PMI, all right? Now, when we talk about the PMI, this is what will really happen. I want really to define this so that we continue on this. Now, we are talking about PMI. You understand now what PMI is where we actually measure what is the cost, the supplies, everything at the raw materials before even we move to the production level, right? These measures before the production level are that one, maybe supply of the raw materials and all those sort of things. That is where all these things comes in. Now, that is where we are talking about the cost. Assume now the cost of transportation increases. Assume now when you want to transport these raw materials, the prices moves up. The cost of buying the raw materials, cost of raw materials increases. All right? What is really going to happen? The production, this is now on the PMI level, right? So it's two things can really happen when these two. Number one is either the company can decide to pass this, to earn this at production level, to earn the cost on production level, or to absorb. They can even decide, what this means is that we have incurred a lot of money by transportation, the cost of raw materials. Now, the next thing that we can actually do in this, we can either decide to pass this cost on the production level, or we can just decide to absorb these prices or say, I can recover later. Let's not disturb people. And of course, you remember where we really started on this, on the cost and the price and the demand. Because when the demand is low, of course, and the cost was high, instead of hiking the prices, they just decide to keep it flat. The company now is the one that absorbs those prices. All right. I want us to touch on the next one because the PMI, Purchasing Managers Index, leans to what we call the PPI data. This is the PPI. Just name it quickly. Quickly. I want us to move. You can pause and just, what's this? What's this? Is a producer price index. Producer price index. All right? This is very simple when you talk about the producer price index. Actually, this gets warning. Is get warning. So these are kind of things that you really have to write down. This gets warning from PMI. As you know, the company actually decided not, they incurred a lot of things, transportation of raw materials are expensive. And then, you know what? They decide not to absorb that. So what they're really going to do, they are going really to have it here. And now the production is actually going to be expensive. That means the PPI, producer price index, is really going to be very up. It's really going to be moving up. Now, this is what I'm writing. If the company decides to pass or to take in and not to absorb the PMI, then of course it passes here, and then where we have the PPI actually moving up. Do we really get that one? Yes. That is on the producer price index. What else do you really have here on the producer price index? Because when we actually on the production level, when this is actually very big. It's a very big thing, because when you go to the calendar, you're going to see different things. You're going to see PPI written as MM. You're going to see that practically. We are going to see call PPI MM. These are two and different, right? This actually drives the market. You can say this drives current market. I'm going to show you right now. This is where the expectation, this is actually that drives, this drives the CPI later. So we'll be talking about that one. Remember that in PMI links the PPI, then we'll be talking about what it leads later. Now that is the price producer index. So you see, when you see like on these levels here, you saw that the PMI is really above, and then is really moving, is really up. Then the next, of course, you expect the PMI, of course, to just be the same, to even move up in case the company actually decided not to absorb those ones. Let's see, how do you really check these? Because when you move to the calendar, what are you really going to be seeing on the calendar? You can actually go to search event here, and when you write PMI, you're going to see things like that, things like these ones. Let's see, for example, you're going to see a result like this. So above 50 is what we call an expansion. Let's expand this and see, so that you can see what really happened. You are really going to see this even when you click it. You are really going to be seeing it and what it means, right? So for example, action greater than forecast is good for a currency. Because why? Because number one, look at this. The PMI, when it's actually up, is really a sign that the cost of production is really becoming up, and then it leads to the producer price index actually becoming up. I'll show you even the full cycle on why the PMI is actually brings a positive result to this. Now, above 50 indicate industry expansion, below indicate construction, right? Expansion means, for example, it is paying more workers, or there is a production is becoming expensive. Things they are incurring more cost than usual. That's why there is expansion in that case. Now, when you see, for example, this is of Monday, January 5th, around being it 47.9. 47.9. You see, this is PMI 47.9. That is what we didn't get from that. That is for, I think, December, right? So when you go to the next month, of course, you expect things to really drone down. Of course, although it's not that very big. So when we move to the next one, remember this is January 5th. Let's move to the PMI that we really got today and see whether we are going to see some down ones. All right. Let's see US PPI. US PPI, so it was on today. So that was today. Okay, so today 14th. Let me get it full. Yeah, you see, PPI, this is monthly. This is just the core one. You can see actually it was from 0.3, and the forecast was actually to move down, but it actually moved all the way to 0.0. All right. So it moved all the way to 0.0%. And this is actually the cost retail sales 0.5%. That is what we're really talking about here. Now it has to move. Now look at this. This is called PPI. This is the most important thing, as you can see, from 0.3 to 0.2, the forecast, and then it moved to 0.02%, because of course the PMI was just low. This one again is the one that will actually lead us to the CPI. All right. Let's now go to the CPI. What is the really formula for this? Now, this is what we really get. Now, what chart statement do we really have here? Now, what do you say about this is we can write the statement and say end line. What's end line? End line is this one. This one. We are talking about this, right? So end line PPI, which is this, moves the market today, but core PPI moves the CPI tomorrow. So of course, this is the one that moves the CPI. So that is what really normally happens. Remember where we started? PMI is moves to PPI. Then of course, what we will get here is the CPI. Consumer Price Index. This is the next one that we are really going to be talking about. What is really Consumer Price Index? This is the inflation. Assume now the cost of production, the company has actually absorbed or not decided not to absorb the price of production. This one, the price of the phone now rises. They decide now to increase the prices. They now decide to increase the prices. What is really going to be happening? For example, what is inflation now? This actually will cause the inflation. Because what is inflation? Inflation is when we have the same product. For example, this is phone and this is phone here, but this is 2010 and this is 2026. The same phone costs $500 in 2010, but in 2026, same phone costing $1,000. Of course, you can see it's inflation because it's just the same product, but you are buying with more money. That means it's because of inflation, right? That is now where you see the company can actually cost this. And that is the genesis from the PMI. The company decide not to absorb that. They decide to increase the prices. So tomorrow you're going to buy it, it keep increasing and it's going to cause the CPI. Of course, when we have the PPI, core PPI, it's actually going to cause the CPI to react just the same, right? So whether this is going to be increasing, when this is going to be increasing, is it going to be causing this to increase as well? If this is going to be lowering, of course, the CPI is really going to be lowering a bit. Now, what is the prediction for the CPI that will be coming next? Because you are seeing the PMI is going down and it has passed that to PPI. The price of production is going down. Of course, what we expect for the next CPI and data is, of course, to see if the core CPI actually moving down. And the current one is 2.7. Probably now we are going to be seeing lower, either 2.6% from that. So with this information, you can really know whether you're going to buy or sell for the US dollar. This is just the win way, or you can actually get when you're using the PPI. So the most important thing here is the PPI to predict the CPI. So from here, the CPI, why do people really buy? Because this is how really things follow each other. The PMI leans to the PPI, right? Then this leads to inflation. And then what comes is the monetary policy. Monetary policy. Remember now the reason people trade whether buy or sell is just because of the monetary policy of what they predict the central bank is actually going to be doing to that market, is that they're really going to be doing to that currency. And that's why now you see, because now the inflation will be coming, for example, where we are predicting probably the next one CPI is really going to be down like 2.6. When they see this, of course, they are not really going to cut the interest rate because, of course, the inflation is really coming down. It's going to be a way. They're not going to hike the interest rate. Of course, what they are going to do is to cut the interest rate. So this is what we normally predict to see, right? Because once inflation starts moving up, the reason that they cut is because the economy is really doing well, because the inflation is really coming down. But when the inflation actually starts moving up, like for example, it moves to 3.5, this is a threat because the inflation, that means the money is losing value. So the central banks decide, the Fed, in this case, it's the Federal Reserve, what they're going to do, they are going really to hike this interest rate. They're really going to increase the interest rate. Hike means increase the interest rate, cut means reducing. So they are going to increase the interest rate. And that means when people really have money, or there's money or the product into the company, what people are really going to do, everything, there's money in the economy, things are really doing so well. So what they are going to do is they're going to increase the interest rate, at least to take that money from the economy. So at least the currency to gain value, right? And it's the opposite of this. So when we have the CPI that you have predicted right here, because the PMI is down, PPI is down, the probability for the next CPI that we are going to get is probably below 2.7. It's going to be lower than this one. And then this one is really going to weaken the dollar. And if, for example, you are trading this example, if the CPI, you can actually start from the trading now from CPI. If CPI actually drops, this means what? This means future interest rates cut, okay? And what that means is that the weakening of that dollar. So US dollar, USD weakens. And what we mean by weakening of the US dollar, if for example, if you are trading XAUSD, then that means gold is going to buy. If you are trading USD, JPY, right, it means it's going to sell, because this is going to be weak, this is going to be strong, all right? It's going to be weakened, this is going to be strong. The US dollar is becoming weak, so the price of the gold moves up, and this one becomes weak, of course the pair moves down. It's just the same to give the beginners a chance to understand. This is where like we have numerators and denominator, okay? In this case, the dollar, in the gold here, dollar is the denominator, so where we have XAU up and dollar down. So that means it's just like 1 divided by 0.1. And this is just an example. When you divide this is going to give you 10. But when you lower, when this weakens and becomes 0.01, of course you see the prices moves up, like it is move up. It's just the vice versa of this one. That's why the prices actually start moving down. Now that is where we start. I hope you may be able to understand where the market start, the genesis of everything that we really get. And I want you later to check the next PPI, because we already got the PPI, we already got the PMI. I want you to check. This is on January when I'm recording this, and go and check the next CPI data. Let's see what is really going to be given. I say the 2.6 core CPI, lower CPI, and will be prepared to buy the bonds during the CPI economic news. Thank you so much for watching up to this. I'll see you in the next video, where we are going to be having the next formula, because we have not really discussed a lot of things, because now we are going to be talking about the job opening, right? This is another leading indicators where we are really going to be leading us to the CPI again, to the interest rate on how to do this one. But for that, understand the PMI, PPI, CPI, and the interest rate on that formula. That is what normally drives this market. That cycle, PMI, let me repeat again so that you may, PPI, right? It leans to again to CPI, and then the CPI, monetary policy. Okay, it's just like a cycle, and then monetary policy affects the production costs, the supplies of all these things, the items from the genesis. It actually, it's how we treat. This is actually like the medicine. You can actually say here it's the medicine. So this is Indian brufen. This is a joke in Kenya. So this is like a medicine that we give to the market. All right. Thank you so much. Subscribe to this channel if you have found this to be helpful. Bye bye.